Okay, in this video, I'm going over profitability ratios. Profitability ratios, there's four general ones that we're going to discuss. Profit margin, return on equity, return on total assets, and gross margin ratio, right? So these two are virtually the same. And then these, not the same, but they're very similar. And then these two are very similar. Okay. So gross margin ratio, I also think we've talked about it a number of times throughout these lectures, but gross margin, that's simply sales minus cost of goods sold. And we're just presenting the gross margin as a percentage of sales. So sales minus cost of goods sold divided by net sales. Obviously, the higher the gross margin, the better, right? The gross margin is essentially the cost to, or it's the difference between selling price of the product and the cost to make that specific product, or at least acquire that specific product. We have profit margin, which is the same concept, but instead of using the gross margin, we're just going to use a line item further down the income statement, which is net income. So it's just net income divided by net sales is the profit margin. A lot of people will mix up the terminology, gross margin, profit margin. Remember, gross margin is just the difference between sales and cost of goods sold divided by sales, whereas the profit margin is the difference between net income and sales. Then we have the next two are very common things that analysts will look at, and novice traders, stock market traders, may look at return on assets and then the next one, return on equity, and trick themselves into thinking that some company either potentially poses a buy opportunity or could be ripe for a sell opportunity. And I'll just say I would really caution you against hanging too much of your decisions on these two analyses. They're interesting, but that's about as far as it goes, in my opinion. Okay, so return on total assets, that's just the net income divided by average total assets. And again, the average total assets is beginning plus ending divided by 2. And I'm thinking the higher the return on assets, the better. However, the problem with return on assets is that if we're looking at a well-established firm, the amounts that are on the balance sheet with respect to total assets, those are book values, not market value. And so if you're looking at an older company that's fully depreciated its assets, it's going to have a really high return on assets because the base is fully depreciated. If you're looking at a relatively new company, it could be the case that its return on assets is relatively low because it's not fully depreciated all of its assets. So I tend to put little weight on these. They are interesting, and it's important to at least understand the computation. However, we do want to, at some point, slow down on putting too much emphasis on these. Return on equity, same concept, right? It's the net income divided by average total equity. And again, average total equity is a concept that's book value, not market value. And return on equity, therefore, can be misleading in some instances. But nonetheless, it is an interesting calculation.